So welcome everyone to the February 2022's QAFFU meeting from Boston. We are live with Dr. Larry Pohlman, who has been a friend and a mentor and a teacher for many, many years. And he's one of the leading quants in the area. And he's presenting his work on rational factor rotation. And I'm just going to read a brief bio of Larry. Larry has a distinguished career covering 30 years of experience in equity, fixed income, and asset allocation. He regularly speaks at professional conferences and is widely published in prominent journals. He has taught investments, corporate finance, fixed income management, and advanced derivatives at Columbia Business School, Northeastern University, where I also teach at times, and at the University of Massachusetts, Boston. Larry was the Director of Research at BMO Global Asset Management, Chief Investment Officer at BNP Paribas Investment Partners, Director of Research at Wellington Management, Director of Research at Panagora Asset Management, Director of Fixed Income Research at Independence Investment Associates, Vice President at BlackRock Financial Management, and Associate in Mortgage Securities Research at Goldman Sachs & Co. I believe that covers the entire financial industry, all the companies. Larry holds 5 degrees: BS in nuclear engineering, MS in operations research, MBA in finance and management science, MPhil in finance, and PhD finance from Columbia University. That covers all the degrees Columbia offers. And is a member of the American Finance Association, Boston Security Analyst Society, Econometric Society, and the Chicago Quantitative Alliance, QAFFU, and Mensa. Welcome, Larry, and the stage is yours.
All right, thank you, Sri. All right. Yeah, actually, Columbia offers several other degrees. I had one of my colleagues who went on and got a 6-pack. He went and he did a law school and got a JD. Thank you very much. It's always great coming back to QAFFU. I think about 1.5 years ago, I presented the first version of this type of analysis on sector rotation. And along with my colleagues, we've got the paper accepted at the Journal of Portfolio Management. Will be coming out in July. So hopefully this paper, this is a real rough draft, we'll follow that, and we're going to continue on with that. My co-authors, Debashish Gua and Mike Watson, who's here today, will also be launching a hedge fund using these types of strategies, hopefully by the end of March. Debashish, I go back with him all the way to Columbia. He was in the management science department. I was in finance. He taught me how to play Chinese checkers. He's a master in bridge and a couple of other things as well. He worked at the Cycle Center at Columbia for a long time. Michael Watson is a very unusual. He has a very unusual background. He's been a West Coast guy for most of his career. He spent the first 10 years after he got his MBA at UCLA working in a lot of different shops, including the B of A, where he basically, I guess, client service, product development, and that sort of things. After 2011, he decided to change gears, and he started working at Warner Brothers, making films. And he did that for 10 years. You know, a lot of the famous movies that you and I can think of, he was part of in some way, shape, or form. Then I guess he got tired of that, and for the past 12 years, he's been running his own firm, basically a forecasting. He used a lot of technical analysis, but fundamental as well. About 6 years ago, he came to Boston, and that's where we met, and we had a very good time. And I'm happy to say that I would look forward to being a partner with him in crime here. So let's see. Here's an introduction. I'm going to try and keep this quick. There's 18 slides, and we'll probably get through them pretty quickly. The idea of this factor rotation is that, just like any rotation strategy, is that if you can get a higher annualized return than just in this particular case, the aggregate market, And we start by showing that, first of all, you have to always start these papers with some economics and the rationale for it. And in this case, we show that for an optimal investment strategy for rational investors is factor rotation. It can be a lot of other things, but factor rotation is one possibility. What we're going to do is we're going to show you the impact of performance of an investment strategy, rotating the positions in the Fama French factors. And we're using a Markov switching model along with the VIX in order to demonstrate that. And then furthermore, we can really improve upon the performance by allowing each one of the factors to switch on their own. So here's an outline, quick little outline. We'll talk about expected utility. As I said, we got to throw in a little economics first. We're going to get the famous Fama French factor, famous Fama French 4 factors. Try and say that 3 times fast. It's the market minus RF, it's the small minus big, it's the value and the risk-free rate. And we're also going to throw in the S&P 500, T-bill, and the aggregate, just so we have some things to compare the results to. We've got daily data from Yahoo Finance going back to 1998 to present. So it's something like close to 6,000 observations. All of the results are done out of sample. So it takes about 5 or 6 hours to run one of these ETFs because you basically start with 1,000 observations and then we add 1 day at a time and re-estimate the model as we're going through it. It's a hidden Markov model. We'll talk a little bit about that and the background on it. I'm sure you're all familiar with the VIX itself, and we'll demonstrate how using the Markov model, you can identify high and low volatility states. And then we'll do the same for the ETFs. I'm calling them ETFs, but it's still the Fama French factors themselves. We did use the ETFs for the spider and the ag. And then we're going to look at the performance under a couple of different crisis periods, just to show some differences in how the factors perform. So here's your expected utility. The classic idea is you got one risky asset and one riskless. The risky asset follows geometric diffusion with a mean of mu and a sigma standard deviation. You got a riskless asset and you got a power utility. And in that case, your optimum weight in the risky asset would be equal to that ratio of the excess return over the volatility times the utility function. If you assume that the asset follows a mixture of normals, then with a hidden Markov state, then you're going to end up with 2 optimal investment strategies. One is going to be W0 and the other is W1. And those are different by their means and their standard deviations. And that all comes from the hidden Markov model. This is particularly coming out of the Kim and Nelson 1999. That's the equation of motion, if you will, for the returns. And what we're really interested in is that mu. It does have a mean and it has a standard deviation, and those are the 2 things that we're going to try to estimate. And you can see the equations for them. They have a combination of that and the state variable, which is a 0-1 type of variable. And the key thing coming out of all of this is that little transition matrix that you see over in the right-hand lower corner. This is the transition is the idea that if you're in state 0, the P00 tells you how long you're going to stay there. And you're going to stay there until you move to P01. You'll stay in that for a while, and then you can move back. So that's how the whole model works, is basically in the transitions. So if you want to do any research on this, there's a lot of very good papers recommended here. If you want even more, I can send them to you. There'll probably be even more at the end of the paper when we're finished with it. But Engel and Hamilton is probably the godfather, I guess, or the originator of most of the switching models themselves. There's 2 very good papers there investigating the Kang and Phillips using macro factors, and you can use them as well. And Alexia and Tiaga, they did it with a sector rotation on using fundamental data as opposed to Kim and Nelson. Very comprehensive, easy to read. Probably you don't need a degree in econometrics in order to get through that. Mark Kritzman and our own Dan D have done a lot of dynamic strategies and demonstrated the importance of those as far as investment strategies are concerned. And as I mentioned in the beginning, the sector rotation strategies were we developed it being published in July issue of JPM. All right, so Fama French factors, the market minus the risk-free rate. These are the classic, the small minus big, large, small cap minus low cap, and then value versus growth or value minus growth and the risk-free rate. And it has really changed the world, I think. You know, it really was the improvement on the capital asset pricing model that at the time people were very excited about it when they first came out, and then they started discovering all these places where the capital asset pricing model seemed to fail. And Fama French said, well, let's try some other things. And when they introduced that to the model, the performance improved. And you know, now I think it's up to 6 or 7 factors that have been included in the model. All the data is available from them on their Fama French website, so you can get to that data and analyze it. I half kid with people that I'd like to put in a bashing of the Fama French factors. It's just every person that's doing a finance dissertation nowadays has to spend some time with the Fama French, whether it's relevant or not. You can't get your dissertation accepted unless you say something about it. So that's all I'll rant and rave about Fama French. Okay, so we're going to look at a couple of different ways of constructing portfolios based upon these switching models. And the ones that we're going to use are, first of all, we're going to start with looking at the VIX and how much the difference in the portfolios would change depending upon the state of the VIX itself. And then for each factor, we'll estimate a switching model for the factor, and then we'll look at combinations, portfolios that are combining them. So let's give you some idea what this looks like. Here's the VIX is that solid green line that's going through the slide here, and you can see it peaked, you know, right around the financial crisis, back in the 1998 and so on. There's another crisis, and we're sort of off the end here. You can't see the current crisis that's been around since 2020, basically. You know, a lot of people say, well, why don't you just use the level of VIX itself? And you really need to get more of the behavior by looking at the changes in the VIX as opposed to just the level itself. The level itself works pretty well, but making a dynamic model does a little bit better. So the squared off lines are the actual probability that's coming out of the switching model. And you see it spends a lot of time. It doesn't spend a lot of time in between the states. It's either all in or all out. There are a couple of little bars in there where you see it fluctuates around. And in our experiments we've done several times is what we say, if the probability is above 0.5, we'll call it a 1. If it's below 0.5, we'll call it a 0. And that just smooths it out a little bit. But I think it's only about 5% of the time over this entire history is do you have to make an adjustment to the VIX in that way, in this particular. So just to give you some idea, if you run all the factors through the switching model, you end up with these very interesting little graphs. A very good friend of mine has helped me put those together and how you stack the graphs as far as putting them into the presentation here. So the VIX is all the way at the bottom. You can see it's pretty, it's just like if you went back to the other slide, you can see it's pretty much following that kind of pattern. You have these long periods where the model is just definitely on or off, and it makes sense if you look back and you say, well, what was going on in the world at those points in time? And then you do have events that pop up every so often, and the VIX will jump and it'll return. So those don't last too long, as I said. If you were worried about one of those transition states, what we do is we can essentially leg into a position. If you're at a very high VIX and it starts to move down, so if you say, well, when it goes to 0.8, I'll sell 20% of my portfolio, then another 20%, another 20%, so that you don't get really whipsawed. You'll just, I guess I call it legging in. And there's a lot of common features here, but your eye might be thinking that it's really the same thing going on. But if you look at them in a little bit more detail, you'll find that there's enough difference in their behavior that they do have independent influences. By the way, the top one I just threw in there, that's not one of the ones that we're analyzing tonight, but that's another one of the factors that I just happen to have it and I included in this. So what do we mean by the VIX switching? Well, literally we took the VIX, ran it through the switching model. When it came out, whenever the VIX was in a high state, we hold T-bills. And when it's in a low state, then we hold an equally weighted portfolio of the Fama French factors. So that the notion is that when VIX is high, you don't want to be in assets. The returns are going to be lousy. And in fact, we'll see that in a moment. And just for comparison's sake, we do a second portfolio, which is the reverse of those positions. So in the high one, we own the Fama French factors, and the low one, we own the T-bill. There's then another way we can do this is instead of switching all of the factors at once, we can only switch the factors that have are in high or low volatility states. So in the first case, we're calling S1 there, if in the high volatility states for all factors, then you only hold the T-bill. And in the low volatility, you hold a quarter of the weight for each one of the low factors. The variable weights are allowing now the factors to come in and influence the portfolio itself by having either a combination of a T-bill and one of the high volatility factors or one of the low volatility factors. And the same thing, we can have another strategy that reverses them. So the three recession periods we're going to look at is the millennial, of course, that probably is the one of the longest ones that there really is. Oh, actually, I changed I was just editing the slide and I was trying to input. One of my colleagues insisted upon calling this the Great Recession, and I've got a problem with that because I don't think that any recession can be great. I suppose it depends on how you interpret the great, but I crossed it out. And we have the financial crisis, which is actually the Great Recession would have applied to the millennial period, basically. And then we have the COVID, which started in February of 2020. And technically, as far as the market impact is concerned, it ended in March of 2020. But we left it continuing because of the impact it probably has, or continuing to have, except for the fact that the market was up tremendously last year. So it's a little bit distorted. So here we go with the tables that are impossible to read, but I hope you can understand them a little bit. Let's just look for the full period here. The first top line there, that's the return on each one of those either ETFs or factors over that period of time. So you see the market was at 7.87, small minus big. HML actually has a pretty low return over this entire period, but we can see that doesn't reflect differences in time. You have the risk-free rate and the spider, see S&P basically there. And if we run down just to the bottom line and we look at the low VIX row, for example, you can see that under the low VIX, the return on the market is much higher. I mean, you're talking 3% higher than the full period. And similarly with the high VIX, it's lower, not as substantially, but a decent amount. Small minus big has a curious behavior in the VIX in the high and the low risk states, is that in the low VIX, it actually underperforms, it has a negative return, and it actually performs better in a high VIX environment. So this is one of the factors that kind of has a reversal. And you could probably think exactly that's the type of thing that you'd want to identify, because if you were in a high VIX state, you'd want to overweight the things that have a better performance. So in that case, the portfolio would probably hold more of the small minus big. H minus L is exactly what you expect, and you can see a big difference in the spider itself. Now for the three different crisis periods, I don't want to go through all of them in any kind of real detail, but I can see the millennial across the board. I think what's more interesting than anything else is that the factors have pretty decent returns compared to the full period of time. It's kind of interesting. You'd say, wow, under these crises, these things are performing well, but I guess it makes some sense. You could tell some stories about that. You have the negative returns for the millennial and financials for the market as a whole and for the S&P. And finally, we're going to look at these portfolios that we've constructed now. And just keep in mind that return on the market, that SPDR is 8% or 7.5 for the market factor itself. So in the V1 state, remember that's switching back and forth from the T-bills to the volatile factors. So you get about the same return. No huge differences. I mean, the risk is lower. If we go back and look at that, the risk is a fraction of what it is under. So it would be 19.9 for the market or 19.74. But here it's about half of that, less than half of that. So you have reduced the risk on the portfolio itself. You can go across there and look at the loadings on the individual factors. But the real astounding differences become a little bit later here. First of all, you see with the V2, that's holding the opposite of what you think is a good portfolio. And yet, indeed, you get a very low return with a very high risk. If we go down, the real differences start to kick in the switching portfolios where you allow the factors to move on their own. And for example, the return is now 13% versus 8%. It's like a 5, almost 6% improvement in the portfolio, and the same thing holds in the S3 state. Little higher volatilities, but again, nothing compared to the markets themselves. So these are pretty decent investment strategies to follow. There is a curious thing about the R squared on these. Remember, we're running the regressions on the Fama French factors, and it is curious that it's always in the bad, the high volatile states that you get the highest R squared on the models, and you can go across and look at the coefficients on those, and they're just kind of very, very, very interesting. Huge T-stats. The Fama French, they've definitely done something right as far as identifying the factors in the marketplace itself. So, conclusions. We want to switch, depending upon the factor ETFs, to bonds in high volatility states measured by the VIX, and it outperforms and holds. The performance improves when the factors are allowed to rotate on their own. That's probably not too surprising. And in times of crisis, rotating the ETFs could really, really enhance the performance. I think it's pretty clear from the results that returns of volatility are negatively correlated, at least over substantial periods of time. We know they can be positively correlated. The negative relationship can be used to construct pretty high return switching portfolios. We're seeing it. And it's best when you allow individuals to switch on their own. So I was worried about running over, but I guess I don't have to. Any questions?
So can you talk about particular triggers of VIX, like numbers? Or how? Can you hear me?
Yeah, I'm sorry, Michael.
Yeah, it's all right. I was very interested to hear about the hedge fund.
Oh, well, I'm a research guy, and I've never really been thinking about investment strategies or do anything else. And Debashis is been pretty busy with his academic career, but Michael's been running a business now for well over 10 years, and he was very intrigued by the performance, and in fact he he started analyzing the returns and thought that he could improve them even with some of the techniques that he uses as far as forecasting models. And he's run businesses, he's done businesses and created new products. So it was kind of like, hey guys, why don't we do something? So it took somebody who's been doing that kind of business for a long time to come along and go, hey, come on, put your money where your mouth is, or your equations. Michael, is that fair?
Yeah, I think that's a fair assessment. I mean, especially in this environment. I mean, there was a period of time where quant hedge funds did not really keep up. But I thought this was a really interesting approach. I think as volatility is obviously, greatly increased over the last year and will probably continue to be, I think it makes a heck of a lot of sense if we can get an extra 500 or 600 basis points of performance with lower than market risk. So
that's the target, 500-600 over spiders, right?
Say again?
500-600 over which benchmark?
S&P.
S&P, right.
Yeah.
500-600.
That's what the back testing is showing right now. And that's without any enhancements that we're using machine learning and artificial intelligence to add a few enhancements, which we think might, at this point, we're up to about 200 additional basis points, and that's back testing it for about 25 years.
Mm-hmm. So can you talk about the trigger points? Like, how do you prevent thrashing about and, just how is it going to work? If you don't want to talk about it, that's fine too.
No. We've met now with at least a couple of people on that would help us in terms of bringing it to a business and getting it up and running. Michael, you've done this before, so you should be answering those questions.
Yeah. Are you talking about Michael Wesson or me?
Yes. No, not Michael. You.
Yeah. Well. So I remember selling the black box was really difficult, to be honest. And it happened. And I don't want to take your time, but if it happened after, the huge Ponzi scheme, so everybody suspected hedge fund managers of wannabes of big Ponzi schemes, and so it was difficult to sell a kind of black box. Yours is not quite a black box, but I'm asking questions that I actually am interested in, because I just told my wife that, you shouldn't invest in large, hedge funds. They just make their money on 2 or 1%, whatever they charge of assets. They don't really need to do performance. You better find 3 hungry guys with a good chance to perform and stick with them until they become like the other ones. So I am interested in the hedge fund, not just the theory of it, but what are your switching points? How often did the model show you were rebalancing?
So, Michael, one of the things I have to say before we sat down with Michael Lawson, I was envisioning running this as a bunch of ETFs. We started with the S&P 500, the spiders. You could easily rotate the spiders without any trouble at all. And the only trouble is setting a fund up with the spiders. Setting up a mutual fund is the most expensive thing you could possibly do. And it would be kind of crazy to do that. To launch an ETF now, it seems like everybody and their brother is willing to do it. Of course, I think it's something like 80% of them fail within the first year. So, but the launching this again, thanks to Michael Watson's experience, he said, well, we don't have to do the ETFs. Well, it may be that somewhere along the line we'll introduce a series of them, but For now, we're going to focus on the launching it and getting the capital up to some level where it's meaningful. That, Michael, would you say that's fair?
Sure. Yeah. Yeah, I think there's definitely a need for a product like this out there. You know, we're not swinging for the fences. It's just a you know, it's a way of trying to eke out some consistently higher return with less risk. There's no leverage. There's no shorting. You know, it's a you know, a business of singles and doubles. I think, you know, there's a very receptive market for that right now.
So the legal form is a limited partnership, a hedge fund, right?
I beg your pardon?
The legal form is a hedge fund, a
Yes.
limited.
Yes, it will be. Yes,
Okay, not another ETF.
that's correct.
Okay.
Although, you know, as Larry mentioned, we may look at forming an ETF down the road if it makes sense for some reason.
Mhm. Okay, I'll let
Question in the
others.
chat window. Sorry.
If I could, question
Yeah.
on the spark lines for VIX and then the Fama French factors. It looks like there's two regimes, one that goes more or less up to the global financial crisis, another one that goes after, a infrequent switching period and a very frequent switching period for kind of all of the variables that you show. Do you have an explanation as to why that would be?
So I think you're referencing like the most recent period, right? You seem to be getting a lot more switching in the VIX and the assets themselves.
Right, and the dividing period seems to be 2009, let's call it.
Yeah, you know, we probably should get a lot more diagnostics on that to dig in. What of course, anything that would move the VIX would move this signal. If you're looking at it from the VIXs themselves, and because if we think that all the assets move with, well, have some volatility in different situations that are going on in the world, that you're going to observe it if any kind of strange things might be going on. So I think you're right. Again, it's a really good comment, because I would like to be able to go back and take each one of those periods and say, yes, we've analyzed that and we know exactly what happened then. It was some type of event somewhere in the world that got everybody upset and got the VIX moving. So I think the easiest way would be looking at how the VIX moves. The factors themselves are then going to be a little bit trickier, because you're going to have to figure out why small minus big is moving in. Well, you know, that's actually a little bit easier to figure out why small cap is outperforming large cap. Well,
But they all seem to be related. Like there's a low switching period and a high switching period, and they all seem to depend fairly significantly on the state of the VIX.
Yeah.
At least the change in the VIX.
Yeah.
Second, a suggestion: if you're going to present this as a forecasting model, you may want to present a confusion matrix, since you're just doing a simple Markov switching thing, which will show kind of a goodness of fit, or when your model gets confused, or if there's a lot of false positives, or whatever the case may be.
That's a great idea, because I am confused all the time. So it's a very natural thing for me to do.
And confusion matrices may make it less, or may make it more confusing. Yeah.
Works for me. I tell people that anytime I come up with a paper or with some idea, I always come to Coffee first, because you get great feedback. You guys are all willing to talk. You're not afraid of asking questions, hard questions, and it really helps the models, helps the product itself. So, yeah, Coffee.
Yeah, the third question would be for something that looks like it adds 500 basis points over pretty naive asset classes, is who's the natural on the other side of the trade? Since you're going to be looking to buy risk-free assets during turbulence and buying S&P during calm periods, who's the natural on the other side of the trade?
That's a good question too. I mean, what are they doing? And they're taking long. Obviously, it's the longs we're worried about. Well, no, because it could be people shorting, right?
Sure.
And we're going to be taking long, so somebody is taking the other side of that.
I mean, it seems like if you're seeking safety when things are turbulent and seeking risk when things are calm, that's kind of what the market's doing and most dealers are doing at the same time.
Yeah, in fact, that's one of the conversations we were having today with, they say, yep, we're just curious, but somebody is on the other side. We know that's for sure.
Like a poker table, who's the patsy?
Yeah, that's a good question.
The nice thing is that by limiting ourselves to 9 very liquid, very large ETFs, with virtually no spread between bid and ask, there seems to be little risk outside of a total meltdown of running into liquidity issues.
Right.
Yeah, that was one of the reasons to think about the ETF format as opposed to a mutual fund. But clearly not the mutual fund. I'm sorry, a hedge fund. I think it'll be easier to raise capital with the ETF has to be open, right? But we don't have anything to hide here. I mean, it's just the spiders. So if you want to follow us, go right ahead. Hi, Sarah.
Hi. Question for you. What's the turnover running in this back test?
Oh, great question. And that somebody asked me a similar or related one, which is what's the maximum drawdown? And I went, I don't know. So
I know for one of them that I've been looking at quite closely, just for running some different AI approaches. I think that the total days where we generated a signal that we wanted to be out of an ETF was only about 5% over the last 25 years. So 5% of the sessions in the last 25 years did we get a signal where we wanted to be out of an ETF, and that was for just one particular one.
But that meant you were getting rid of that whole position.
Right. So we, would rotate out of that position and into perhaps a more favorable one, or into T-bills, one or the other.
Okay.
Did I say that right, Larry?
Yeah, that's correct. Because there's several ways I'm running it. Well, at least there's 2 ways that I discussed running it. One is you turn the signal into a 0-1, and then you're all in or all out. Or the other way is I'm calling it legging in and legging out. You move partially into one or partially into the other. So, but like Michael said, they're you don't really have to worry too much about these guys. There's good volume, there's good size, and they've been around for a long time. So it's pretty reliable to be able to go ahead and take a look at them. One thing I may have alluded to, but I haven't done any. Well, I've done some work on it already. Is to look at the other ETFs, the value and the growth, the cap ETFs. There are about 40 of them. I looked at this. If you take the big BlackRock, the spiders, you take the 3 or 4 major dealers, they all have enough ETFs to cover small cap, large cap, mid cap, high and low. So you end up with a real nice, not outrageous number of securities to trade, but a substantial ability to go across the marketplaces if you wanted to. So that's paper 3. So maybe next year I'll be back again and asking you to think about that as another alternative strategy. And then there's country rotation. You can imagine all the different types of rotation, types of products you could base on this type of strategy. So.
Hey, Larry, quick question. Have you ever looked at the quality factor as part of the HMM? It seems like that is like a go-to factor, for in times of market stress. Just curious if you thought about that.
Yeah, you're right. I mean, we've looked at it under the crisis periods. It definitely, each one of these factors, now, just to make it clear, these are the Fama French factors, which means you can't buy these things really. There's way too many stocks in them. And so the best you can do is you can get somebody who's either replicating them somehow or doing something close to it. So, I mean, in fairness, full advertising, open kimono here. These are I'd have to find, and I should have done this already. I should have found the real ETFs that you could use to trade, and to see whether or not that holds up. So it's a good question. Thank you.
And a question on the Fama French factors: are you using quintile or decile spreads?
You know, honestly, I don't know. I literally went to the Fama, French's website, and I downloaded the series. I think you can probably get them on Yahoo Finance also. So you're right. They're neutral portfolios, right? I suppose is the best way to describe them.
Yeah, I think the standard way in the academic literature is to do the quintile spreads.
Yeah.
And if you're looking for commercial ways to replicate that, most of the value growth in small, big funds look more like tertile or even kind of binary spreads. So you're going to get much less of a difference than if you use like the top 20 and bottom 20%. So your effects are going to be much more muted if you're looking for a commercial solution.
Interesting. All right. Okay. It's another good point. Yeah, I'll dig a little bit deeper into what the actual Fama French factors are themselves. Unless you knew right off the top of your head what the spreads were.
Yeah, I think the quintiles is the standard way to go.
Quintiles, okay. Yeah, as Michael said, we're trying to avoid shorting anything. Not because I'm against it at all, but the long positions are a little bit easier to manage and not have to worry too much about them. So get in and get out.
Also, if you try to backtest some of those small, illiquid, anti-momentum quintiles during the global financial crisis, really woolly borrow rates that you can't simulate unless you have access to whatever the borrow rates were for those stocks.
Yeah, you made a important point there that it's one of the other Fama French factors, right? Is the momentum.
Yeah.
Although I think they don't want to use that for some bizarre reasons. They don't talk about momentum, right? I think that was somebody else who discovered that factor.
Yeah, that's why they didn't use it, because they didn't come up with it.
Yeah. Yeah, I think it was actually a guy. One of the guys was in the PhD program at Columbia, and I remember him producing this thing. And he was running the CRISP tapes over and over and over again. And I was like, what in the world are you doing? And he said, well, we're working on this. I said, no, you can't make any money that way. That's what I was.
It was that Columbia guy and a guy you may know called Cliff Asness. Yeah.
Yes. But that's when I was a student. I didn't understand what was going on. Anyway. Well, there's the draft papers available. I sent it to Shri. I guess he could make it available to you along with the slides if you want those. And you got my email if you have any ideas for. I welcome any comments and suggestions and any ideas that you might have. That would be helpful.
Well, I'll put those slides and the paper link alongside with the video and share it with you. Hugh, you can probably send it out later, Hugh.
Okay.
So may I have one more?
Sure, Michael.
Yeah, I didn't want to monopolize. So it's kind of like, once you see it, it's an obvious strategy, right? That doesn't mean that the invention is trivial. That always happens when you have a genius invention and you say, how come I didn't think about it? But I find it hard to believe that there are no similar strategies already employed where that dreaded difference between backtesting and the real life shows its ugly head,
So I think the question that came up before is like, what is the drawdown? How long are you going to be able to hold your nose when the market's moving against you? I guess is kind of what you're saying, right?
Well, things happen. That this is why, just people do back testing, and then the stuff sometimes doesn't work.
Yeah,
and it's just almost like bad luck because you can't explain it. If you've done an honest back testing and things still don't work out. So I'm trying to not knock what you intend to do, but there should be similar strategies already employed with real money for 10, 20 years. And there should be knowledge of the experience.
it's absolutely true, but it's what do they say? I mean, what does it take for horses to race? Just a difference of opinion. Some people are comfortable with these strategies. Other people are saying, "What the heck is that?" No, I know I can pick stocks. We're not going to put those people out of business, and God bless them. I think you could improve performance on different strategies by just trying to do something about managing the volatility. I think that's the ultimate lesson coming here is, things are going to be different when the markets are volatile. So why don't you try and somehow incorporate that in your investments? Yeah, and then I know what somebody's going to say is like, well, then if everybody did it, and then I think of the famous book, what's it, Slaughterhouse-Five.
No, I'm not worried about it. You're going to be too small at the beginning to worry about everybody did it. You just do. But there's like 26 participants. Does anyone know a guy across the street that has been running a similar strategy for 10 years? Anyone?
Maybe he has, but he hasn't told you. He hasn't told us.
Oh, I don't know. So if I knew, I would have unloaded on you. I don't know.
Yeah.
But that's not what I do for a living now.
Yeah.
So I'm not supposed to know.
But,
I think someone at BGI who used to be at State Street, he's got a factor rotation model.
Okay.
It gets better than that. The up to the global financial crisis period reminds me a lot of Andrew Lowe's thought experiment in his early book, where the best performing strategy of all is just long the S&P 500 and selling out of the money call options on it all the time until it just out of the money put options on it until it absolutely crushes you during the global financial crisis. That low switching model that you have is economically very similar to the strategy he was outlining. And even if everybody knows about that strategy, it still can blow you up, regardless of how little or much money you have.
You're right, because you had been using the volatility to evaluate the options, right? So
sure, yeah. You never got to the high volatility state until the wheels came off the economy.
Yeah. I think it's from several of the questions. It's all coming back to we got to show a little bit more on the diagnostics on the downturns in the products. So thank you. You guys have driven that home.
Well, I was trying to provoke 25 people and nobody gets provoked. Kind of disappointing.
There we go.
I'm going to put my thing on and I'm going to start threatening you.
All right.
Okay?
Put your mask back on.
Well, this is good, Eric. Okay, we're going to start threatening them. Somebody ought to know about similar strategies in real life.
Well, I think we're going to find out. We're dealing with some prime brokers, and they'll probably have seen everything that you could possibly imagine, and we'll get any feedback from them if they've said, "Oh yeah, we know 20 people who are doing this." Like, okay, good.
So actually, if you're interested, Larry, give me a call. I know a couple people running ETFs using ETFs for
that'd
regime
be great.
switching models.
Okay.
And there's some tricky operational difficulties there.
Yeah. All right. All right. So what's your hat?
So the Electronic Frontier Foundation is the ACLU of online. It combats people like the CIA. So when I saw Michael with his hat, I had to put on mine to counteract him.
No, I'm here to just get out an opinion about similar strategies that have already been employed. And I can't get it, but I guess. And not to, to jinx your hedge fund, but just to understand what might be hiding there in the switching strategy. The people that did it with real money had already discovered it. You understand?
One thing my colleagues, my partners in crime, if you will, they said, well, Larry, you're getting the signal at the end of a day, and then you're buying the following day's close.
Yeah, things like
okay, so this is really out of sample. You can't. But they said, wait a second, why don't you buy today's close? I said, well, wait a second, that would be cheating. But I guess, when it comes to actually implementing it, we'll.
Yeah, there's a real-time VIX available at 345. You can do buy or sell on close orders.
Yeah. I mean, in principle, I guess you could turn it into a day strategy, although the VIX doesn't move. I don't think it moves enough during the day to make a big difference.
Yeah, the 2 sigma moves in VIX only happen once, a lot more than once in every 100 days, but they're infrequent changes.
Yeah. So we're just for fun, we're looking at same day, end of day trade, next morning open, and the next day's close. And we're going to run them all and see what differences pop up. Obviously, there's a lot of sessions where interesting things happen overnight. So
yeah, Michael says that, and every one of those is going to take me 6 hours to run on each ETF.
Time to get friendly with your Amazon Web Services salesperson.
Yes. Thank you very much. That's exactly what is coming very soon is the AWS implementation. We got to industrialize it anyway. Get the data into the database and make sure it's all set up so it can run automatically. Good points. Good points.
But there are some cheaply available. If you give me a call, there are some cheaply available commercial databases already resident on AWS. And I noticed you had RStudio. There's some pretty easy implementations there that'll save you a lot of time.
Yes, I would work in R, but my colleagues are like, Larry, you got to be Python nowadays. And I'm like, okay, I suppose.
There's some pretty good Python implementations too.
Yes. In fact, we ran when we were doing this original research. The students were running Python, and they ran most of the original tests through Python, and I was running through R. So we get substantially the same results. So the algorithms may just converge a little bit differently.
Yeah, if you want to go beyond simple Markov switching to some neural networks, Active Python has some better libraries with Keras and PyTorch and some of the other neural network libraries.
Yeah, that's where our co-author Debashi, that's kind of thing that he teaches to students and has been doing for quite a while. So they actually, the students had tried, but they tried some things near the end of the research period and they didn't find too much. So I'm skeptical, but like I said, I'm not familiar with the particular strategies and techniques. So it'd be nice to find something that works or doesn't.
Okay.
You know who to ask if you have any Python questions, Larry.
I think I'm going to be taking some of your classes. All right. Well, thank you, everyone. Again, appreciate it.
Awesome. So, Hugh, next month, do we have a confirmation from D or still?
We do not.
Okay.